Hi, I'm Linda Eads. I'm going to be giving you an update on the RECM Global Fund, looking specifically at the second quarter of this year and talking a bit to the performance of the fund relative to global markets in general, and then looking at the Global Fund as it's positioned currently. So if we look at the performance as a starting point, the fund was down about 2.5% in US dollar terms after fees for the quarter. That was pretty much in line with global equity markets. If you look at an index like the MSCI All Countries World Index, that was also in fact down by 2.5% during the quarter. If you take that a little bit further back and look at the fund's performance over, for instance, the last year, it's actually outperformed the MSCI All Countries World Index by about 2%. It's up about 9% versus 7% for the global equity market in general. And that continues to be the case if you just take that further back to the start of the cycle. In other words, when sort of the shift started happening towards value-oriented portfolios in early 2016. The Global Fund has performed very well since then. It's up 42% as we stand mid-July after fees versus the general market, which is up about 36% over the same time period. And again, I think that's quite remarkable given that the makeup of our fund is very, very different to the stocks which would have driven the return of something like the MSCI All Countries World Index. So the drivers of that performance were very much correlated to the themes in the markets over the quarter. And effectively what you saw was the US market performed quite well. That was really on the back of the US dollar strengthening, which was something of a reversal from the first quarter where the US dollar in fact was quite weak. And emerging markets coming under quite a bit of pressure for the same reasons, as well as US sanctions on markets such as Russia, Iran, and a lot of geopolitical tension and local political issues as well in places such as Brazil. So if you look at the portfolio, it's very geographically diversified, and some of that exposure is to emerging markets, which continues to be a source of value opportunities in many instances. And some of the Brazilian stocks in the portfolio, such as Porto Seguro, such as Itaú, did come under a bit of pressure during the quarter as a result of local issues in Brazil, causing the Brazilian market to be out of favor in general. Things that were very positive for the portfolio were, for instance, our position in Tesco that continued to perform very well. There seems to be a little bit of a shift back in favor of the UK. Or put it this way, it seems that the negative sentiment that surrounded the UK as an investment destination due to Brexit seems to have been alleviated somewhat. So it seems that the underweight to Britain that a lot of portfolios has been lessened somewhat. And you can see that has had quite a positive impact on a lot of the big UK stocks, like for instance Tesco. The market does seem to like what Tesco is doing in its turnaround, and we of course agree with that. We think that they are doing the right things and that the business is sort of coming through its difficult times and is positioned well going forwards. Other sources of return in the portfolio were some of the energy stocks. Of course, oil prices went above $80 a barrel again, and that was very positive for stocks such as BP in the portfolio. And then the sort of whole shift in favor of US consumer-oriented stocks was very positive for shares such as Williams-Sonoma, which is the homeware retailer in the US, which we have a position in the fund. In terms of changes to the portfolio during the quarter, they were mostly driven by share price movements. So for instance, Next PLC has done incredibly well since we introduced it into the portfolio in the third quarter of 2017. It's up actually almost 50% since then in US dollar terms, which just goes to show that value opportunities can unlock very quickly. It doesn't necessarily always have to be the case that it's a 3 to 5 year time horizon, but unfortunately the timing isn't in your control. So we actually took the opportunity to exit that position completely, having done very well out of that. We also reduced our exposure to the resource stocks that had done well in the quarter. So for instance, BHP Billiton, we reduced our position to Williams-Sonoma, which I mentioned had done very well during the quarter, along with many other consumer-oriented stocks. And we took the opportunity in Russia, for instance, where there was a lot of price weakness overall in the equity markets, and with US sanctions having been sort of announced, to reintroduce a stock which we had in the portfolio previously, had done very, very well out of, but had exited out of completely, and that's Sberbank. That's the big domestic retail bank in Russia. With prices having pulled back quite considerably, we actually reintroduced that. We put a small position back in the fund. and we also took the opportunity to increase our exposure to the Russian retailer X5 Retail as well. So concluding with how the fund is currently positioned, no huge changes in terms of overall asset allocation, still cash of 25%, equities of roughly 75%. The makeup of those equities is very different to something like the MSCI or Countries World Index, which would have sort of over 50% of that would be the US. We have about half of that in the US. We have about 25% exposure to the US, and it's not to the FANG stocks, it's not to the big tech stocks. It's actually to stocks like, for instance, Williams-Sonoma and Tapestry, and a lot of the businesses that are a little bit more cyclical in nature and had gone through a very tough time with the global cycle sort of playing through. A lot of those are doing very well, and the fund continues to be tilted towards a lot of businesses with emerging market exposure, which we do still see as a value opportunity in many respects. Obviously, we do look at each business on a case-by-case basis, and then when we look at the overall portfolio, we make sure that we don't have any sort of extreme concentration to one investment idea which sort of can sway the portfolio entirely. We want it to be as diversified as possible, which it is. In terms of sectoral makeup, it's interesting to see that the resources sort of exposure is now quite considerably less than financials and industrials. The resources exposure is in the teens, which is obviously a very big change from how the portfolio might have looked 2 years ago or 2.5 years ago, but that's obviously reflects the fact that resources have done so well during that time period. And the sort of dominant portion of the portfolio really is the industrial side, and then a mix of financials, those that have some emerging market exposure such as Standard Chartered, Spurbank as I mentioned, and then sort of the big sort of financial stocks like Berkshire Hathaway in the US. So a very nicely diversified portfolio, which we think still has quite a bit of upside in terms of that kind of shift back to value-oriented portfolios. It's avoiding a lot of the sort of very expensive stocks which are trading on excessive multiples. I think that should be very comforting to investors, and it's got a bit of cash in it as well, so that that will act as a buffer in market declines. It has acted as a buffer sort of year to date when the markets have been under a bit more pressure at times. The fund has tended to hold its ground very well, and we're very comfortable with how the global fund is positioned going forward.